I'm Mark Gagan, and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. It's the ultimate job of a broker to make insurance and reinsurance deals happen. You can't make things happen if you're too shy to talk to anyone, or not good at listening. And once you've listened, then you need to be empathetic and understand the nuances and intentions of the parties to a transaction. You also need to be able to make a point eloquently and sometimes forcefully. All the above explains why brokers tend to make such good podcast guests. And today, as our thoughts start to turn towards reinsurance, the autumn conference season, and the 1/1 renewals that eventually follow, it's fitting that we have a prominent reinsurance broker on the show. Tim Ronda, the CEO of Howden Re, is the consummate reinsurance broker, and Howden Re is the largest and probably most aggressive challenger reinsurance broker of the pack. However, with annual revenues approaching $600 million, I wonder if the word challenger really makes much sense anymore, and we might soon be simply describing Howden Re as an additional global reinsurance broker to the three that now exist. This conversation is a great primer for the state of the reinsurance market, with a broker who now has the critical mass to get good visibility on large swathes of it. It's also a chance to have an update on the most ambitious reinsurance broking build-out of recent times, and check in with where this now maturing project is heading. Tim's a font of knowledge and really good fun to spend time with. I really enjoyed this podcast, and I'm sure you will too. Tim, welcome to the Voice of Insurance.
Hello, Mark. How are you?
I'm really well. Really enjoying the summer. I hope you are too. How are you enjoying the state of the reinsurance market, and how would you describe it?
You know, Mark, I'm really loving it right now. I mean, I think it's one of these rare moments where I think everybody can win. We had the tumult and the disruption and the lack of capital in November 2022 that delayed quoting and led to some really sort of stressful conversations. You know, I think as we fast forward to July, August of 2024, a well-run insurance company has raised its original rates to compensate for some increased reinsurance costs, as well as some increased costs, whether it's social inflation for long-tail lines or whether it's increased smaller storms and severe convective storm for property coverages. So insurance companies are making money. Reinsurance companies are making money. They've changed some of the terms and conditions. They've removed some of their exposures and some of their retentions to some of the smaller or non-peak peril losses, and they're making money. And the thing that's really fun is we in the middle who are just trying to make deals happen, because there's more capacity, we're actually able to start being creative and do unique structures again. So I've been in this business since 1996, and there are some periods where one of those three principles are winning and two are losing. There's some where there's two winning and one losing. But I think to be in a period where all three can win is a really nice period. And I kind of hope we're here for a couple of years.
Well, it probably feels a bit like that because we haven't had this new waves of capital coming in. We've had lots of news stories about the potential of them coming in, but they're almost a year late now. They're way over a year late. You've got a market where cedents rediscovered the value of the reinsurance product and how hard it is to live without it, and having perhaps had a decade or more where they could take it almost for granted, and now able to have reset, but also now can actually buy the new limits they actually want. I remember the last very hard market, I was laughing with a reinsurance broker saying, you must be absolutely minting it in. Your brokerage must be flying through. I said, no, Mark, you don't understand. My cedents have got a budget, and actually I just have to spend that budget in a different way. And we're basically spending it by buying a lot less reinsurance than we were. Or if they have got budget, there's no capacity. So it's either one or the other. And the net result for me as a broker is I'm frustrated. I wish I could be doing more, but I can't.
I think that's right.
So you're in a Goldilocks kind of period where you've got that capacity's reloaded, or certainly from reading results recently, it would be say, obviously it's not new capital, but it's retained profits, that kind of capital.
What's really interesting is I think the conditions that caused the market change in 2022 were a little bit different and unique, probably from other sort of market cycles, and that it was a lack of profit cumulatively over a 6 to 8 year period, rather than one thing individually. So I think what ended up happening was investors in collateralized reinsurance lost some faith into people's ability to model smaller storms or non-peak peril losses. Investors in publicly traded P&C companies grew tired of a 6% return on equity rather than a 15% return on equity. And I think it's essentially what's ended up happening is it's going to take a couple of years to convince both sets of those investors that the changes that have been made are long-term changes in profitability that are going to get to sort of return hurdles that people are looking for, rather than just short-term changes that maybe are a little bit luck based off weather. So I think this is an incredibly attractive business. And I think it's one where both insurance companies and reinsurance companies could generate really substantial returns for investors of all forms. But I think it required a little bit of a shift. I think we're seeing that shift, and I think we're going to be in that period for some time. Now, listen, there are some classes of business that went up 300%. They might see some reductions, but those reductions are rational and they're profit-based decisions rather than irrational, an overabundance of capacity and people making poor underwriting decisions. I think these actually are really good underwriting decisions in certain cases. It's just areas where there's been a certain amount of profit. So I think we're going to be in this period for several years where individual classes will ebb and flow. And I think eventually capital will start flowing back into the business in a more material way when people can kind of prove the type of return that they're going to be able to generate for investors is sustainable.
I did my first sort of documentary style podcast at that Monte Carlo 2022 ahead of that 1123 renewal. And I'd never seen anything more clear, having been to Monte Carlo for about 15, 20 years every year and finding it nuanced to say the least. This was the most unnuanced, the most unsubtle, the easiest podcast I could do. Whereas I'm sure that it'll be much harder, more nuanced this year. It was completely unequivocal, almost that, yes, that everyone was in the last chance saloon. And to say, well, actually, if we have another big loss this year, we are not going to reload. I mean, no one's going to reload our capital until we prove to them that we know what we're doing.
Mark, I think you're right. I tell you, we're a broker, which means we need both clients and reinsurers. If we have all of one or all of the other, we still don't have deals, which doesn't work for us. And if you go back to that time period, it was actually scary in that there was a reluctance for people to bet their capital. And despite a lot of efforts, no ability to bring in new capital. And if you think about it, what is reinsurance? Is off balance sheet capital, where we think it's actually more accretive and lowers an insurance company's weighted average cost of capital relative to debt or equity. And I think we've come through this very, very well as a business. And I think the reinsurers responded admirably in the end. But if people can't count on this form of capital, they're going to look at more debt and equity capital, and we're going to see the reinsurance component of an insurance company's weighted average cost of capital decrease. And I had moments in the fall of 2022 where I was a little bit concerned, but I actually think the reinsurance community in the end came through admirably, and I think actually proved the validity of the reinsurance product as a great way for people to think about optimizing their capital structure, which is great.
Yeah, and I suppose at other harder markets, yes, that sort of role of the reinsurance broker to go and find that capital and assemble that capital. It has to be new capital, yep. For example, particularly in the sort of brokers that you're working in. Many of your colleagues have had that history, but that really wasn't a possibility at 1123, was it? It seemed to be, it's just not there.
The business is always going to evolve. And one thing about alternative capacity coming in to support collateralized reinsurers or sidecars or cat bonds, it's really increased the optionality for people. So if you want 1 year of annual liquidity and you think that there's an underwriting manager that's going to manage your money well and to deliver the return that you want for them to deliver, you can do that. So you don't have to do what people did 15 years ago, which is start a new company, put $1 billion of capital into it, try and get an S&P and AM Best rating that allows you to make counterparty credit lists, grow that company's book value by 15% a year for 3-4 years, and then try an IPO at 1.3 book. That can still happen. And we're probably going to see some of that capital flow into the business because we think that the assumed reinsurance business is an attractive one where people can generate those returns. But what we're seeing right now is much more bets on weather that are annualized, that have a quicker path to liquidity. And we saw some of that capital come in back then. We're seeing more of it now. So the premise that this business is attractive, I think, is real.
Sorry to interrupt in mid-flow, but this is just a reminder that you could be advertising right here, right now, and getting your message directly into the ear of key decision makers in the insurance industry. And you'll be doing it while they're absolutely in listening mode. The podcast is the medium of the future, and so is audio advertising. Contact me on mark@thevoiceofinsurance.com, and I'll do everything I can to get you started. Yeah, we had this record year in cat bonds, and in ILS generally, it's been cat bonds rather than that collateralized reinsurance segment or the LW segment. let's say it was the poster child, it was blamed for a lot of things, which is not necessarily fair. Do you think we might see a resurgence in some of that? And if there were a resurgence in the collateralized reinsurance, might that be the signal that the pressure might be off a little?
Mark, I think you're right. Cat bonds have been a really positive returning asset class for cat bond investors. I mean, the cat bonds that are attaching north of the 130-year return time, investors have really generated a positive return on that, over a long, long time, right? And two, buyers like some of the features of it. Multi-year, sometimes nil reinstatement provides more capital credit because there's no additional premiums post-loss. And I think that people like having different forms of capital available to them. So I think that people are now thinking about cat bonds just as a part of their annual cat strategy. And I expect that there'll be more and more money put into cat bonds because it's actually a really high generating class. I think that you're also right. We're going to see more flows into the collateralized re or sidecar world. That will be backing E&S insurance carriers. That will be backing assumed reinsurance carriers. Where rates are, the returns are actually quite attractive. So we're doing our job as a business. And I think we're particularly lucky here at Howden because we have a very unique investment bank that can do a lot of different things, that sees capital probably in a more robust way than others do. So bringing in the capital then for other people to bet, I see more of that coming in because I think the returns are attractive right now.
So you're more likely to get an incoming call than you would have done any time in the last 2 years.
I think that's right. And, there's been some material shifts in the original risk in that what we saw in Gen 23 was retentions did go up. And there is less exposure today within a portfolio for small losses or non-peak perils than there was before.
Yeah.
Now, we're trying hard on behalf of our clients to find optionality and innovative structures that allow them in a mutually beneficial way to sort of lower those retentions that got increased. But I think that in the end, we're going to see more capital flow into this business because we think the returns are there right now.
And I suppose those retentions can be lowered, but at a price that is probably has been discovered rather expensively for some people, perhaps over the last 7 or 8 years, that everyone knows the price for that cover. If you want to reduce that retention, that return period, then it's certainly not going to be cheap.
I think that's right. I think a lot of our insurance company clients and a lot of our reinsurers that are retro clients have discovered that 45 rate on line 1 in 100 doesn't make a lot of sense. And that, thinking about increasing retentions and increasing pricing to think about the smaller or non-peak peril losses more like they think about fire loss and attritional loss, and just sort of pricing for that, I think is a move that many companies have started doing. Now, that said, listen, there's still some areas that we're going to be looking for capacity because there are some more severe non-peak peril losses that people need solutions for. So we're going to be very focused on that.
Yes, so certainly, I suppose if you've got a 45 rate on line 1 reinstatement 100%, the universe is telling you something, that there's probably something wrong with your underlying book and your underlying structures and pricing. What you were saying about higher peak perils, so there's a lot of demand. Would it be the sort of Monte Carlo where all your discussions are going to be about new top layers, that kind of thing?
I think there was a lot of new limit purchased, whether that be for sound risk management practices, growing original insurance portfolios because insurance carriers saw the profit opportunity and took advantage of it, mixed with a little bit of model change in AM Best and S&P requirements. So we certainly did see a lot of new limit being purchased. To be honest with you, I'd see Monte Carlo as it's going to be a really fun one because I don't think that there's an existential crisis out there that's going to dominate every conversation. And I think what will be really fun is being part of the interaction between our clients and reinsurers or reinsurers and their retrocessional partners, where they're just talking about their strategy and how they're going to navigate 2025 to maximize profit. You might have one company that spends 90% of their time talking about how well positioned it is for long tail lines, how well reserved they are, and how they see the current market as an opportunity. And you might have another client be talking about property business or cyber business. I think it's going to be a varied conversation where the theme will be how people expect to generate and maximize profit in 25. I think there are a lot of different ways you could do that successfully. So I think it's actually going to be a pretty fun Monaco.
Cedents are going to come in positively, and they're going to be met probably positively by reinsurers who are hoping to listen rather than, sometimes you just say in the last couple of years, they might have been a bit tone deaf saying, look, it's all very well, I'm not interested. This is what I'm doing. And
I think that's right. I mean, last year, there was a lot of focus over social inflation and adequacy of long tail reserves and what was going to happen to long tail line reinsurance structures. And I think in the end, like any efficient market, it finds an equilibrium, which is, I think a lot of our clients think that for policy year 2024, they're making money on their long tail lines. There might be some reserve issues from 2015 to 2019 or 20, but for policy year 24, they actually feel good about it. So if you were buying a 50% quota share, you're quite comfortable keeping another 10 points net, right? So I think that there was a lot of chat about that last year, whereas I think this year is just going to be much more of a non-emotional, here's our view. We'd love for you to be along for the ride with us, and we value the long-term relationship that we have with you, rather than one particular topic that might be dramatic or a bone of contention.
You mentioned before about a provision of capital to MGAs. That, I suppose another thing that reinsurers have been doing a lot, this is something that's probably changed structurally over the last 10 to 15 years, is supporting MGAs through all sorts of different vehicles. Do you think that has become a permanent change in the marketplace? So it's something that I know that you as Howden Re are well positioned to do, and something you've been doing a lot of. When you're looking at your business plan, is this something you said, well, this is always going to be here? Or do you think, oh, this is something that might be a bit cyclical, that might change, that might ebb and flow as the market changes?
Mark, we're big believers in the permanency of the MGA world.
I just had Jeff Radke on the show, and it was just phenomenal to see what sort of volume they've managed to put through that platform in such a short time, because he'd been on about 3 years ago, and it was 3 or 4 times bigger.
What I will say is, in the end, there needs to be capital that is providing a home for that MGA produced business, right? So we love the MGA business. Some of our clients are extraordinary, right? So what are the common characteristics? Often it's very specialized. It could be products like cyber or transactional. It could be general liability where someone just has a particular skill set or a claims knowledge or use of data that's superior. But in the end, that MGA has to produce a very attractive gross profit and think about itself as an underwriter in order to attract the capital that will support it. So I think you're going to have different P&C companies. Some will have very little MGA. They want an employee model, and that's great, and they can thrive. But a great way to add some volume without actually adding headcount is to associate yourself with several attractive specialized MGAs that maybe have a product knowledge that you don't have or can complement the employees that you already have. So while we're massive, massive fans of the MGA space, and I do believe it's permanent, because some people really like working at big companies and they thrive at it and they want their whole career to be that. And then some people are a little bit entrepreneurial. We work in a business where entrepreneurs will always be there. And if we have a forum for them to exist, but exist in a positive way within the infrastructure of the P&Z business, I think everybody wins. But the capital is key, because you could have a bunch of really good ideas, and if you can't prove a return that attracts capital, you've got nothing.
Yeah, and I suppose the other attractiveness is the non-volatility, and they're unlikely to be very property cat heavy, that kind of thing. We had an example of fish drying in Norway, for example, this drying of cod, salted cod, that kind of stuff. Also, you can do anything. It seems you're a big enough expert at it and you can provide that expertise, and you can provide a likely to be very consistent underwriting profit. Then why would someone not want to back that? Jeff described it as ballast, I suppose, is a good way. Perhaps it's not going to shoot the lights out. It's not going to be the sort of thing that provides you with a 70% combined ratio. But if it's going to be mid to late 90s consistently year after year, and you can say, well, this is great, and it's diversifying away from everything else that I'm doing, then why not? And it's fantastic. It's a good thing to have in my mix.
Couldn't agree with that more.
We had the CrowdStrike outage recently. We've had a very positive sort of vibe going through the cyber reinsurance world, with cat bonds being put away, certainly a coalescence around perhaps a greater comfort about what a big cyber event might look like, and more crucially, probably how it would be defined in terms of excessive loss or an ILS structure, that kind of thing. Has that CrowdStrike event, because I suppose it's come from somewhere non-malicious and an E&O space, which I suppose, when I'm thinking about cyber for the last 10 years, that was not a peril I was thinking would be something that would produce a big loss. And of course, this is the great thing about insurance, is I'm always being surprised by things. We always have to scratch our head and say, goodness me, I didn't think that was in the mix. And when we do get surprised collectively, often that leads to a little bit of a rethink, or a bit of a sort of lack of confidence, or let's say, a lack of bullishness, or just a kind of time to reassess. So has it affected the market in any way? And so it's just that basic psychology and that confidence feeling, well, I thought we knew exactly what we were doing here. And now here's another peril that we didn't have in the book.
Yeah, listen, it's a great question. And it's still early days, right?
Because maybe it was in the book. It's just that I wasn't really paying attention because I was looking at all the sexy hacker stuff.
Yeah. Well, listen, I think that you're spot on in the following, which is cyber is obviously an evolving market. We're in an evolving world where cyber has its tentacles being spread further out. And we're trying to figure out what's systemic risk, what's aggregate risk, what's an occurrence risk, right? So when you start thinking about the cyber market, I mean, we estimate there's about 14.5 billion of original cyber premium, right? So if you start with, and I don't know if this is right or wrong, but if people are saying this is $1 billion loss, well, that's 7 loss ratio points, which is actually, I think, really healthy for the cyber market to sort of think about it could withstand a meaningful loss, maybe on par with non-Petya in terms of size, and still actually generate a profit in the year that that loss occurs, right? So I think sorting through the coverage issues, sorting through what happened will be key for the business. And I think we're going to learn a lot from it, because I think no matter how much of an expert you are in cyber, and I am not, luckily I have colleagues that are, you're going to learn something from this that will change the way that people underwrite and will change the way that people look at risk. Being an optimist, I think that markets need losses sometimes in order to prove its case. And if you think about cyber, coming up with a tail risk number in the same way that people can for property or actually derived long tail lines has been more of a challenge. So for an event like this to occur, whether it was malicious or whether it was an E&O, is a sizable event that impacted hundreds of millions of people. So to see what the actual loss ends up being will actually be quite positive, because I think we can then start to put the beginning of some tail work into some framework by which people could actually hold capital to it and use it to think about how much they grow their original premium. I mean, we think about it all the time. When cyber started, the reinsurance was largely quota share. Then there were a couple innovative aggregate excess of loss structures that attached to the 90 loss ratio. And when you think about an event like this, when you think about occurrence and event-based structures for cyber, if that becomes a viable product that clients want to buy and feel like they've got the right coverage for, and reinsurers are willing to sell and they think that they could actually measure the risk, I think it helps explode the overall cyber market, because then people could actually write 150 million of premium rather than 75 million of premium because they have more confidence in their tail. So like any loss, this is a meaningful loss. It's not nothing. It will bring about a lot of questions. At this point, we don't think it changes materially either buyers or sellers' view of that market, but there will certainly be lessons learned that we're going to find out more about over the next 6 to 8 weeks.
There's a possibility of subrogation and recovery. Again,
Absolutely.
If you're paying out in the first instance and then you can prove very clearly it was somebody else's fault, I suppose you can go and ask them to help contribute.
Absolutely.
Let's talk about Howden Re. How's it going for Howden Re within all this? It sounds like it's a good time to be a reinsurance broker. Very good. You've got a good market. You've got good supply. You've got good demand. You couldn't ask for anything more. You've got lots of new risks and lots of people looking to cover them. So how's it going, and how's it going geographically, and sort of where's it going best?
Well, yeah, sometimes I get worried that people are tired of hearing about Howden Re, but
I don't think so. I think you're miscalculating, Tim. It's because I suppose sometimes when you're a leader, you're sort of banging your drum all the time and you think, am I getting boring? But actually, if you don't keep banging it, no one else will bang it for you until you have. But certainly you haven't been on this podcast before, so far away.
That's true. No, listen, we're having a lot of fun. I mean, I like things that are simple. So like our premise is our clients are crucial to us and they require extraordinary service. If you give your clients extraordinary service with deep knowledge, surrounded by relationships where they know that they matter most, how do you do that? It's by having the best people in the market and having those people be motivated and feel aligned with each other. So that's been our premise. I mean, it's been an amazing run. I mean, when I joined Tiger in October 2021, we were 175 million of revenue. Howden Re should close 24 just shy of 600 million of revenue. So I think it's working, right? That includes some business that came part of the Howden Re acquisition, which was a brilliant specialties business in London, a brilliant facultative business, and brilliant binders business in Bowood. But we've been having a lot of fun going like a weed, and it's been a lot of fun to sort of work with our people in that it's a very fun mix, in that a third of our people were Tiger Risk, and a lot of those people came out of Benfield in some way. a third of the people would have been Howden Re, and a third of the people joined us in the last 18 months. So we've got this great melting pot of ideas and talents. The thing that's been fun about it, Mark, is fundamentally, I think the best organizations grow from within and allow their own people the opportunity to advance their careers and do new things. When we brought Tiger and Howden together, we had core strengths in US property, global property, facultative MGA space, but we didn't have a full cyber team and we didn't have as much depth as we do now for US casualty and professional lines. So we've been having fun filling voids that existed either by geography or product around the globe. And everyone's getting along really well and we're having a lot of fun. So I think clients are happy. That's the thing that ultimately matters most to me, which is, do the clients feel we're giving them the best advice and the best service available? If that's the case, then I'm happy with how things are going.
Judging on the amount of times you said fun in that last paragraph, Tim, it sounds pretty good. And I suppose, you must be the recruitment consultant's best friend over the last couple of years, all the hires you've been making. Are you kind of done now? Because you're moving so fast, it's very difficult to know whether you are done. So did you say, have we built what we intended to build? Or is it, I presume you're going to say it's never over, is it? You're always going to be building.
Listen, it's never done. Only in that because we're growing, we're going to want to add people to make sure the client service stays up, right? Yeah. So the answer is we never want to be in a position where we're not reinvesting in our people or reinvesting in clients. That's the whole point of getting scale, right? Which is our ability to reinvest in tools and analytics and clients and people that service those clients is even greater. So we're always going to be adding individuals here and there. I think that you are correct in terms of where we sit when we think about our ability to either work with an MGA who's specialized in one class, a client who's specialized in one class, or a global insurance company that may want us to work with them on something. We feel quite comfortable that we've now got the product and geographic split where we could put an expert in for a conversation with any client anywhere. So I think what you'll see is we're certainly going to slow down on the hiring. And it's because I think we feel really comfortable with the talent base that we have. Yeah. Now, that said, we want to be a home for the most talented people in the world. So if people are interested in working with us, we're always willing to have a conversation. But I think that you're fundamentally right, which is the scale by which we've been growing will succeed. And we're now just going to add individual talent that will complement client teams that will add value to clients.
So it's built the big ship, but might add a few new decks and bars and nice bits to it, for the cruise liner. But it's kind of, it's there, it's out there and floating in the sea kind of thing. It's not going to be fundamentally different.
You're exactly right. Listen, our talent base for people with 1 to 9 years of experience is extraordinary. And some of these individuals are operating at such high levels. I think what we want is to have a culture where everyone believes that their career expansion's better here than anywhere else. And if you think about good enough, old enough, and allowing people to sort of achieve exponentially fast success, that's what we want our culture to be. And that's how we want our people to feel. So, I think we want to move those people along as fast as possible and have them build deep client relationships and add value so that they feel like working here is their best career choice.
So you certainly feel that if there's a tender almost anywhere in the world for almost anything, you'd be able to happily put yourself up, particularly against those other big three that we know the names of.
I think that's right. And to be honest with you, I don't care about the league tables and I don't care about where we're ranked and I don't care about how people refer to us, right? I want people to refer to us as people that passionately give them the best advice in the most unselfish way. And wherever that puts us, I'm happy with.
Yes, I suppose if you're at 600 million as journalists, we should start talking about a big four, but it sounds like you don't really care whether it's big or not.
I'll let people refer to us any way they want. As long as our clients and our reinsurers that are so valuable to us are happy with us.
As long as they're happy. Yes, that's more important, far more important. The constituent parts of Howden and Tiger, and obviously now there's the third cohort being all your new hires. Howden and Tiger, historically, we would have described them as journalists as challenger brokers. And we all know what happened, that there was an opportunity in reinsurance broking, certainly that was very clear, triggered particularly by that Aon Willis attempted merger. Now that is maturing, and you've absolutely matured, do you think that there's likely to be consolidation of some of those challenges?
It's hard for me to say. I've never been good about commenting about other people's strategies. So I guess I'd sort of start with us, which is I don't see M&A as being something that Howden Re has any interest in.
You've kind of done it.
Now, that said, if I put sort of an industry hat on, it is hard to reinvest in technology, tools, and capability if you don't have a certain amount of scale. Whatever the number is, I think it's hard to be a $50 to $100 million revenue reinsurance broker and reinvest in the same way that our clients and our colleagues demand.
Is that because the kind of ticket prices are very high for some of these exciting technological and analytical tools that your clients might be wanting you to help provide them with?
That's right. You have to constantly be reinvesting. So like whether it's generative AI or it's data scientists or it's databases, you can't give the best advice to people unless you're using the latest and most sophisticated tools in order to give that advice. And it's not free. So I think ultimately there are really incredibly good reinsurance brokers that work for small companies that are going to be successful. They're going to be successful in things like ILW, in other things where creativity, innovation, and quality relationships drive success on deals. And I think that there will always be smaller, quote, challenger brokers because entrepreneurs, some people don't want to work for a company with more than 20 people, right? They're really intelligent people all over the world. And those intelligent people will find ways to add value. I think for a full scale operation, it's really nice to have some scale associated with it because the ability to reinvest is necessary and we have a greater ability to do so.
So yeah, there's always a smaller broker. When we think they're all done, it never seems to be the case. Obviously, look at Tiger itself, that came from not much. And again, obviously Howden also having built something, again, almost from scratch with a bit of M&A.
I agree. I mean, and again, I could have this wrong, but I think Howden Re really started in 1987, right? And a couple of geniuses and industry titans built up a reinsurance business and bought a whole bunch of reinsurance brokers across Europe. And so I think that in the end, our business is going to constantly change and there are going to be some innovators that want to look at things differently. So I'm never one to sort of say that someone can't do something. I think a lot of these smaller brokers could thrive, but just thrive in a way that's a different set of goals and objectives than maybe we have here at Howden Re.
When I look at lots of reinsurance brokers, obviously I talk to lots of reinsurance brokers, one of the strings to their bow that some of them say they've got is to be almost that manufacturing center, or the sort of people in white coats innovating, trying out new products, partly with a very specific purpose of manufacturing new products that could then be distributed through the retail network. Obviously, Howden is now globally a very significant retailer. Is that one of the strings to your bow? Obviously, it won't be the only thing you do, but is it something you have a specific objective to do as well?
I guess, yes. I think that you're right. I mean, if you think about it, capital is what drives this entire thing. So if you want to innovate a new insurance product and you're talking to 8 insurance carriers about this new product creation, they're going to immediately say, okay, great, but I'm going to need reinsurance for it, right?
You say, I'm going to talk to Tim. And I suppose if you're the retail broker and you already know they're going to talk to Tim, you think, well, I might as well talk to Tim straight away.
That's right. So like, I'll give you an example. As David Howden's been very clear about, he's got a real passion for sustainability. And he really thinks that we as a business need to do more as it relates to products around climate change and a new world in which we're going to need to think about things a little bit differently. So we have now several colleagues that are at a group level focusing on climate. And it's a good example of what you talk about, which is whether it's parametric insurance or parametric reinsurance or carbon credit insurance or CAT insurance for small and developing countries that maybe don't have insurance penetration rates that are high enough for them to sustain a 15% hit to their GDP. So it would be a good example of that's probably where we are in manufacturing plant, because in the end, we can talk to reinsurance capital over the returns that they would think they need to generate for either carbon-related products or CAT-related issues for small and developing countries, and allow that known cost then to be passed through the insurance product. So the manufacturing plant can happen anywhere and any time, but mostly happens on new product and new product creation, which is actually really fun, right? Because you get to sort of maybe have a less than perfect original data set, but a quality set of assumptions where we think we could generate a return for capital. And that return for capital on the reinsurance, that return for capital on the insurance needs to be proved. But I think we're going to be a lot of new product development where we're the manufacturing arm of Howden, and working very closely with our specialty colleagues who in fact are incredibly good too.
But generally, it sounds like it's demand-led rather than you won't just go out and manufacture a load of stuff and say, hey, look what I've done.
I think that's right. We want to be in a market where we're creating new products innovating around structure and allowing win-win opportunities for insurers and reinsurers. And to me, that's where we're most helpful from a product and from a manufacturing perspective.
Obviously, Howden doesn't have a US retail operation. Is that any kind of impediment to the growth of Howden Re?
Speaking from a Howden Re perspective, my answer is not really. Howden Group has a giant insurance broker, as well as a sister company that's separately run, but MGA business, where more than $20 billion of gross written premium flows to insurance carriers today. Admittedly, the vast majority of that is outside the US rather than inside the US. But I think that we want to, at Howden Re, get client opportunity by the quality of our ideas, by the passion that we bring to client service, by the team, the depth of experience of the team that we're putting in front of them. I think it really is helpful because it's natural. It's great that we can be a great partner with an insurance company where they get original insurance gross written premium, maybe some assumed reinsurance gross written premium, and they're also a client of ours. But from my perspective, well, I would love it if someday Howden was one day in the US in a more meaningful way than it is today. I don't really think about that on a day-to-day basis because I'm just so happy with where the group is structured right now.
I was looking at my questions. I think we've talked about almost everything. One thing I haven't spoken about is generative AI, which you've mentioned. I don't think we could be doing a podcast in 2024 without mentioning it because it's sort of entered everybody's consciousness over the last 18 months, particularly. Where do you think within the reinsurance segment, do you think it'll make the biggest impact?
I think we're going to learn a lot by trial and error over the next 2 years. And anyone that knows me knows that I am the furthest thing from a generative AI expert, which is why it is great that I've got colleagues that are. But I just sort of think about it in general. The data sets that people are using allows people to be more successful using generative AI around those data sets. And I think we're already seeing data in general, and then maybe generative AI adding to this, helping reduce expenses. So that could be expenses for P&C insurance carriers. That could be expenses for insurers. That could be expenses for insurance and reinsurance brokers, right? So when you sort of think about having powerful technology that can do things at pace and at speed and maybe done more cheaply than could happen anywhere else, you could see an immediate lowering of expense associated with deal count, right? And that actually helping those that are largest most because they have the most savings per transaction. Secondly, you sort of look at generative AI, and I'll use Progressive as an example, their use of data and predictive analytics and their pricing algorithms that allow them to run at incredibly attractive loss and combined ratios is a market leading thing and is a thing that's distinguishing to them. So I think the next phase of this will be how can we use data sets and then generative AI around those data sets to give our clients better advice on how they should be thinking at pricing algorithms, either on a assumed reinsurance portfolio or on a original insurance portfolio. And I think that's the holy grail. If you can use data in a way that allows you to price the business more efficiently, to consistently generate better underwriting results over time, that's really valuable. The expense stuff is valuable, but the underwriting stuff would be really valuable, which is there a 400 basis point spread off industry loss ratio that you, carrier A, could generate because you more effectively use data sets and generative AI? So we're investing a lot of time right now. I would say some of these projects I'd classify as fun, right? Like we've all can go on ChatGPT and ask them to write a poem in Shakespearean language about the reinsurance business. I don't know how you make money at that. So the balance of this cool new toy and then using it to make money or help our clients make money, we're still discovering right now.
But it sounds like the focus is really on that skill, on anything that will give you an edge, that will give you something that might give you a chance of improving your loss ratio by 4%, that kind of thing. Although you're saying expense ratio almost as much.
I could see there an impact of both in the long term.
Or productivity as well. One presumes, again, that you could just place twice as many reinsurance programs in half the time and make 4 times as much brokerage, that kind of thing.
Yeah, I mean, listen, reinsurance is a people business. We all could just look back at November 2022. There's nothing about generative AI that could have helped complete our clients' placements back then. So, I go back down to Mark. This is a people business where we need to be really intelligent about using the most advanced technology to give advice to our clients to help them maximize profit and reduce volatility. And that's where we're going to be focused on.
Well, it seems like a very good place to end. I wish you all the best. It sounds like you're still marching on very much.
We're marching on. We got a lot still to do.
Well, the people that you've got are going to be marching fast, but you might not be recruiting so much. You just be able to get your heads down now and just get on with it now that you've built it.
I think that's right.
Well, excellent, Tim. I really, really appreciate your time. It's been a really interesting discussion. Yes, and you've been really candid as well, which is really kind of you. So come back on the show soon, but I'll see you down at Monte Carlo, I expect.
Yeah, absolutely. Enjoy the rest of summer.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.